or another, all with observability requirements that include hyperscaler platforms, Kubernetes container orchestration, cloud-native applications, and modern DevOps practices. Some of these companies are transitioning off outdated monitoring tools, while others have been trying to cobble together their own modern cloud observability solutions, and all considered multiple alternatives before selecting Dynatrace as their digital transformation partner. On the expansion front, global leaders such as Travelers Insurance, Lloyds Banking Group, Toyota, Lowe's, and DHL expanded their use of Dynatrace this past quarter, and all now use 3+ modules of Dynatrace to cover their multi-cloud observability needs. As I've said before, once a customer experiences the ease of scaling, the power of our automation, transformative opportunity provided by our AI capabilities, they quickly look for opportunities to extend Dynatrace further across more application workloads and across broader metric and log use cases. So when we say the market is moving toward us, we mean just that. The macro trends of applications eating the world, digital transformations as multi-cloud first, and the need for automation and AI capabilities on the rise put us in a very strong position for continued new logo and net expansion success going forward. This brings me to my second topic this morning, taking advantage of this fantastic market opportunity we have in front of us, and that's through increased investment in commercial expansion. You'll notice our sales and marketing spend has returned to our target range of 34 to 36% of revenue, a combination of three key efforts: Salesforce expansion, partner momentum, and doubling down on market awareness. Our sales engine continues to scale. We grew our quota carriers by nearly 30% this past quarter and expect to continue growing this team in the 30% range throughout fiscal 22. Productivity continues to be healthy, and the talent we are bringing on board has never been stronger. Dynatrace is considered a top company to work for around the globe, and our customer-first culture resonates with sales and go-to-market talent. Helping to lift productivity are the cloud system integrators and strategic tech partners. Our partner community is now influencing over 45% of our transactions globally, and the leverage we are seeing through the hyperscaler marketplaces is growing even more rapidly. In fact, the number of deals closed with hyperscaler partners this quarter increased by more than 4 times compared to the same period last year. Our reputation for reducing risk and accelerating project success, especially for projects at scale, is catching the eye of more and more partners and their community members. As we've said, our partner program is an important area of focus for us as we scale beyond $1 billion. Third pillar of our commercial expansion is increasing the brand awareness of Dynatrace. A recent study showed that within our target account base, the Global 15,000, we are now known for much more than APM. Our efforts to expand awareness to observability, infrastructure, logs, and AI ops is paying off. We have more to do here for sure, but the awareness trends are scaling in the right direction. To help accelerate these trends, we recently completed a series of 12 one-day Dynatrace sessions around the world. We call these Dynatrace Go events, where customers and prospects hear from peers how they're leveraging Dynatrace to digitally transform faster, smarter, easier, and at lower risk and lower cost. We had over 20,000 registrants across these 12 events, and most exciting to me was a balance between customers and new logo prospects. 70% of the 20,000 were new logo prospects. Like I said, there's more work to be done to be better known for the value advantage we provide to digital transformers, but we are gaining on it every day. The third and final topic I'd like to cover today is the maturing of the depth and breadth of our platform and its growing number of monetizable modules. Our 3+ module customer count continues to climb. Today, over 40% of our 3,000+ customers leverage Dynatrace across 3+ module use cases, and over 45% of our customers now use us beyond full stack applications for infrastructure and log-only use cases. Our infrastructure module, which includes modern cloud metrics, open ingest, and log analytics, is our fastest growing module, with ARR growing more than 90% year over year. It's now fully featured and robust and capable of winning against any infralog alternative, and a big reason why we continue to win modern cloud observability business at a steady rate. With over 1,000 engineers now, we continue to advance all modules aggressively, embracing new technologies, extending capabilities, and enhancing use cases. Though there's much to talk about here, let me focus on just one of our new modules, our Cloud App Security module. As we've said, we are still in the early phases of market adoption and product maturity, but the feedback so far is exciting. One of our banking customers who recently trialed the AppSec module told us that people and process limitations have prevented them from scanning more than once a week, even though they're deploying updates 2 to 3 times a week. This left them with potential vulnerabilities. With Dynatrace, they realized they could have real-time coverage 24/7, and that's huge. Another customer, a government agency recently migrating to Azure, said that as they started rolling out cloud-native applications, their existing security tooling quickly became cumbersome, slowing them down and with output no longer actionable. Amazingly, in just the trial, Dynatrace was able to immediately detect nearly 100 vulnerabilities that needed fixing. They've now deployed this mission-critical app securely, thanks to Dynatrace. It's clear from these and many other examples that our value proposition and timing could not be better. The DevSecOps movement is gaining momentum, and there is no good answer for continuous vulnerability detection with intelligent scoring to reduce risks while accelerating ongoing innovation. We continue to see a powerful greenfield opportunity for this new module and are excited with its potential to rapidly scale within our base during the second half of this fiscal year. The need is there, and the deployment is frictionless. With that, let me summarize, as I've covered several important topics this morning. We have an incredible long-term market opportunity, and we are investing aggressively to seize the advantage. Commercial expansion is increasing, and continuous innovation is being delivered across all modules. Our platform continues to mature, and we continue to scale well beyond our APM roots. We are gaining new digital transformer logos at a steadily increasing rate, and the net expansion of our base across multiple modules continues to be robust. And it's the compounding of these two, new logos to the franchise and maintaining a healthy net expansion rate above 120%, that we believe provide us the building blocks to sustain a 30% plus growth business well into the future. Let me now turn it over to Kevin to take us into our financial results and guidance. Kevin.
Thank you, John, and good morning, everyone. As John mentioned, we delivered another great quarter, setting us up for a strong fiscal 22. The investments we have made in commercial expansion that drive sales productivity are evident across all of our top-line metrics, with ARR, revenue, and subscription revenue exceeding our guidance. We believe annual recurring revenue is a key performance metric of the overall strength of the business. ARR for the first quarter was $823 million. That's up $222 million year over year, 37% growth as reported, and 32% in constant currency. Excluding the perpetual license wind down, which was roughly $25 million or 4 percentage points, our adjusted ARR growth was 41% as reported and 36% on a constant currency basis, all up sequentially from Q4. The building blocks for sustained ARR growth rate remain the same. The new enterprise logo additions to the Dynatrace platform, combined with how well we expand existing customer relations as measured by our Dynatrace net expansion rate. As John said, new logo growth in the first quarter was very strong, with 135 new logos added in the quarter, and we have been landing our new logos over the past year at a very consistent land ARR of a little over $100,000 per new logo. This new logo growth represents a 52% increase over the 89 new logos we added in Q1 of last year, which is a soft compare due to the COVID environment. We ended Q1 with over 3,000 Dynatrace customers. Consistent with historical trends, once customers see the value of the Dynatrace platform, they are eager to adopt new modules and expand coverage. This is evident in our net expansion rate, which for the 13th consecutive quarter was at or above 120%. As a result of this, our ARR per Dynatrace customer continues to increase, and in Q1, it was $271,000 per customer, an increase of 19% over last year. Adding on to that, we continue to see notable strength in both the number of customers with 3 or more modules and the expansion of the average ARR per customer in this cohort. At the end of Q1, more than 40% of our customers are using 3 or more modules, with an average ARR of nearly $500,000 per customer. We now have over 1,200 customers using 3 modules, and this cohort increased by well over 400 customers over the last year. Moving on to revenue, total revenue for the first quarter was $210 million, $6 million above the high end of our guidance, and representing an increase of 35% year over year, or 29% in constant currency. Subscription revenue for the first quarter was $197 million, an increase of 36% year over year, or 30% in constant currency. We are very pleased with the strength of our ARR and associated revenue performance, as it further validates our strategy to accelerate investments in sales and marketing. With respect to margins, total non-GAAP gross margin for the first quarter was 85%, in line with last quarter and Q1 of last year, a very healthy margin reflecting the power of the Dynatrace platform. From an investment standpoint, we continue to make solid progress investing for growth. Our R&D organization is now 1,000 employees, and we invested $30 million in R&D this quarter. That's up 44% from last year and approaching our targeted investment level of 15% of revenue. On the commercial side, we continue to scale our sales organization, which, as noted earlier, is tracking to 30% sales rep growth. Likewise, our partner organization has grown by over 30% in the last year, and we continue to invest marketing dollars focused on brand and pipeline development. Our sales and marketing investments are up 66% over last year and within our targeted investment zone of 34 to 36% of revenue. With these levels of increased investments, we continue to run a balanced business. Our non-GAAP operating income for the first quarter was $54 million, $3 million above the high end of our guidance range due to the revenue upside. This led to a non-GAAP operating margin of 26%, compared to 33% in the first quarter of last year. Again, keep in mind we saw significant savings in the first half of last year related to the COVID shutdown, and our Q1 margin profile was more in line with how we exited fiscal 20. On the bottom line, non-GAAP net income was $45 million, or 16 cents per share. This is a penny above the high end of our guidance range, primarily due to the favorable revenue upside. Turning to the balance sheet, as of June 30th, we had $387 million of cash, an increase of $137 million compared to the same period last year. We are pleased with our continued healthy cash generation and believe it puts us in a strong position to consider strategic business investments where there is an opportunity to accelerate our growth in selected areas. Our unlevered free cash flow for Q1 was $81 million, or 39% of revenue. Remember, due to seasonal variability, we believe it's best to view unlevered free cash flow on a full year basis. We're extremely pleased with the strong start to the year, and this achievement puts us in a good position to deliver on our previous guidance of 29 to 30% of revenue for fiscal 22. The last financial measure that I would like to discuss is our remaining performance obligation, which at the end of the quarter was about $1.3 billion, an increase of 46% over Q1 of last year. The current portion of RPO, which we expect to recognize as revenue over the next 4 quarters, was $710 million, an increase of 41% year over year. Though RPO may become a more meaningful metric for us in the future, we continue to believe ARR is the best metric to understand the performance of the business because it removes variability associated with billings and contracting changes. Now let me turn to guidance. As I outlined last quarter, we believe the investments we are making in commercial expansion and product innovation will enable us to maintain 120% net expansion and at least 15 to 20% new logo growth over the midterm. These are the core building blocks that lead to sustainable ARR growth rate over 30%. With respect to fiscal 22, we expect ARR to be between $984 and $996 million, up 27 to 29% year over year, or 26 to 28% in constant currency. This is an increase of 1 percentage point across these growth rates when compared to our previous guidance. Keep in mind, our ARR guidance assumes 3 to 4 percentage points of headwind to ARR growth rates in fiscal 22 due to the perpetual license wind down. We expect this headwind in the second and third quarters to be a little over 4 points, and then it will decline to about 3 points in Q4 and drop thereafter. Excluding the perpetual license headwind, our full year adjusted ARR growth rate is expected to be between 29% to 31% year over year on a constant currency basis. Wrapping up our ARR discussion and seasonality, as we have outlined in the past, our business continues to have strength in the back half of the year, with Q3 being our strongest quarter, followed by Q4. Moving on to revenue, total revenue for the full year is expected to be $902 to $914 million, up 28 to 30% year over year, and 26 to 28% in constant currency. Underlying that, subscription revenue is expected to be between $848 and $856 million, up 29% to 31% year over year, or 27 to 29% in constant currency. That's an increase of 2 percentage points for total revenue and subscription revenue growth rates when compared to our previous guidance. And we continue to expect subscription revenue to be 94% of total revenue, driven by the size and strength of ARR and associated subscription revenue growth. Moving down the P&L, we expect full year non-GAAP operating income to be between $208 and $218 million. As we continue to message, we are investing for the long-term sustainable growth of the business. We believe the proper levels of investments for sales and marketing to be in a range of 34 to 36% of revenue, and R&D to be around 15% of revenue. The result of this is a non-GAAP operating margin of 23 to 24% of revenue for the year, consistent with prior guidance and up from a dollar standpoint due to the higher revenue guidance. For the full year, we expect non-GAAP EPS of 60 to 63 cents per share, which is up a penny from our previous guidance. Our non-GAAP net income and non-GAAP EPS calculations assume a non-GAAP effective cash tax rate of 12%, consistent with prior guidance. At these investment levels, we are able to continue delivering strong unlevered free cash flow margins. For the year, as I just mentioned, we expect unlevered free cash flow to be $262 to $274 million, or 29 to 30% of revenue. To summarize our full year guidance, it is a continuation of our durable balance of growth and profitability, guiding to a rule of 50 plus business when combining ARR growth and unlevered free cash flow margins. Looking at Q2, we expect total revenue to be between $219 and $221 million, up 30 to 31% year over year, or 28 to 29% in constant currency. Subscription revenue is expected to be between $206.5 and $208 million, up 31 to 32% year over year, or 29 to 30% in constant currency. From a profit standpoint, non-GAAP operating income is expected to be between $53 and $55 million, representing 24 to 25% of revenue, and non-GAAP EPS of 15 to 16 cents per share. In summary, we are very pleased with the overall momentum of our first quarter performance, with strong ARR and top-line growth combined with healthy margins. We remain very excited about the high growth opportunity ahead of us. As John mentioned, the ongoing market dynamics continue to drive the market toward us. We are investing in commercial expansion to accelerate go-to-market success, and we continue to expand our platform and module strength to address the full $50 billion TAM we see ahead of us. Overall, we believe we are well positioned for sustained and durable growth rates in fiscal 22 and beyond. And with that, we will open the line for questions. Operator?
Thank you. We'll now be conducting a question and answer session. If you'd like to be placed in the question queue, please press star one on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star two if you'd like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing star one. One moment, please, while we poll for questions. Our first question today is coming from Kash Rangan from Goldman Sachs. Your line is now live.
Hi, thank you very much, and congratulations on the quarter. John, I'm curious to get your thoughts at a high level as you try to scale the business to its true potential, which could be multiples of billions of dollars. How do you think about the broader commercialization of the Dynatrace platform, whereby today you've got a business model that is relatively high ASPs relative to where the industry is operating? At what point do we start to see a thinning out, if you will, of deal landing points? So you're able to target a multiple of the 3,000 customers that you have. So generally, infrastructure software companies that are very successful at scale have a customer base of tens of thousands. So as you think about the company's strategy longer term, how do you thin out the landing points and have a commercial sales channel that is able to target a much wider user base? Granted that you do extremely well and you have very high concentration of your modules across 3,000 customers. How do you make this even more mainstream? Thank you so much.
Akash, appreciate it. So first, there's nothing that precludes, our platform from being able to scale, down market. We've just decided as a business to stay focused, at least in these first few years, on what we see as the most sort of lucrative side of the business, which is a global 15,000. In fact, about 70% of all IT spend is done by that global 15,000. So it's a massive market in and of itself, against this, this huge TAM that we're looking at. So there's plenty of room to continue scaling out in every customer and across, an ever-growing, sort of set of modules the 6 we have today and, more we envision for tomorrow. So, we like where we are. We like the focus. It's paying off. We're really good at supporting, these high-end, high-scale digital transformers, and you can see it in our numbers. We're just good at it. But like I said, when the time comes to, go to the global 25,000 or further, there's nothing that precludes us from being able to expand, down market.
Wonderful. Thank you so much, and congrats.
Thank you. Our next question today is coming from Sterling Auty from JP Morgan. Your line is now live.
Yeah, thanks. Hi, guys. So I wanted to ask about the hiring and the ramp of the new sales reps. With 30% increase, are you seeing very consistent growth and productivity out of the new reps that you're adding quarter over quarter, especially now that you're getting to bigger and bigger numbers? What changes have you had to make, to be able to make that possible?
Great question, Sterling. A lot of growing the sales organization like we're doing, comes from anticipating, the scale, because you need a superstructure, of management as well as an expansion of your onboarding program, sort of to fan it out into the field. Can't all be done, via headquarters. So we have a combination of things going on. But I think, the sales, management would say that the biggest change over the last, 12 months for us is the quality of the talent that we're attracting, as a high growth, very successful, company, one that's focused on customers and one that's focused on, sales success. So, a little bit of its culture, drawing in some great talent, and we're doing a better job of developing that talent quickly, I think. And it's showing in the numbers. The last dimension is just the coverage. As you scale a sales organization, each of the sales reps end up with, sort of a portfolio of customers they can actually get to.
as opposed to a list, but they can't get to them all. And so it's also helped us, significantly with broader coverage. We go deeper with existing customers. We reach new customers faster, and it's all good. It's all paying off.
All right, fantastic. Thank you.
Thank you. Next question is coming from Bhavan Suri from William Blair. Your line is now live.
Great, thanks. Can you hear me okay?
Hi, Bhavan.
We have you, Bhavan.
Great. Congrats. There was a great RPO and billings numbers all around. I want to touch a little bit initially, John, on the competitive environment here. Over the last 18 months, we've seen sort of new products being introduced, both by you but by competitors, pricing model changes in some of them, deals in some of those competitors. Just some sense of what you're seeing in competitive front, any change, and then any change in more in terms of the trend around win rates.
Bhavan, in some ways, there's been very little change. In other ways, there have been some larger changes. The little change is really around sort of this competitive dynamic everybody seems to worry about in this space. Really, from our perspective, it hasn't gotten any more crowded, nor was it really that crowded to begin with. Certainly at the enterprise level, the digital transformer level that we focus on, it's been, it's pretty simple. There's less than a handful of players that can play there, and most of them fall away the minute you get to scale, multi-cloud kind of scale. On the other side, what is happening is there is a marked shift toward observability, which is much more of a platform, sort of concept where customers are tired of, sort of the fragmentation of all the piece part tooling, and they really want to see, more of a platform consolidation of their tracing, their metrics, their logs, et cetera. And we anticipated that, as 7 years ago when we rebuilt our platform and refocused it. So we've been leading, and we've been trying to, progress the concept of observability in the market because we think it gives us strength in our landing zone. It's a new and expanded landing zone, and it also sets us up for quicker expansion, which we're also seeing. So, that's probably the other, dimension of this, where there is some change, and, it's change for the good for us.
Yeah, no, that's helpful, and I think you're right about that shift towards observability, especially with your partnership with telemetry too. I guess one other one from me really quickly is when you look at the net dollar retention rate, it's remained relatively consistent and really, really solid. But as you look at sort of when you're expanding into a company, I'd love to get a little color around the split between selling into adjacent kind of use cases or departments, right? So maybe going to e-commerce or usability or something like that, versus selling more modules into an existing kind of use case. So I've got sort of like the guys doing the data center, and now they want everything measured. So help me think through how that deepening versus broadening plays out to drive NDRR.
Yeah, sort of varies by customer in a lot of ways. There's the very large customers, have more sort of fragmentation between teams of who does what. And so to move from the application layer to the cloud platform, where more of the infrastructure, play is, that's just moving, to a different group that's adjacent to the first landing zone, but a little bit different characteristics, different careabouts, and so that's one. But what we're seeing most of the time, honestly, is that, we're landing with multiple modules. The vision, even if somebody doesn't buy them all at once, the vision is already planted that they want to expand to multi-module use, provided the landing zone tastes good. I love the fact that we are so consistent with that landing zone. It means that we're not sort of elephant hunting, and we're staying focused in our sweet spot. We know the product tastes so good when somebody gets it, and it just expands rapidly. So, I'm really pleased with that. But,
The module expansion comes in two different ways. Some of it's super straightforward off of the initial sort of vision we plant with the customer, and other ones take a little more time. The larger customers take a little more time, but obviously they pay off too, because the size of those companies can be quite large when they're billion dollar businesses. Overall, just looking at that growth, the 3+ module growth, where we have nearly $500,000 average ARR per customer, and growing year over year. I think we grew it from maybe about 30% of our customer base to now over 40%. That's just a great progress, and we expect it to continue. I'd be surprised if we weren't picking up another chunk of percent of our customer base over the next 6 to 9 months. We're doing well with it, and we're excited with the progress.
Yeah, no, you can see that even that infrastructure growth of 90%. Congrats. I mean, those are great numbers. And thanks for taking my questions, guys. Appreciate it.
Thank you.
Thank you. Next question today is coming from Matt Hedberg from RBC Capital Markets. Your line is now live.
Oh, hey guys, thanks for taking my questions, and congrats on the quarter, and also congrats on the 2-year mark of the IPO. It seems like 2 years has gone fast, but I think we have a lot to look forward to in the future here. So congrats on both those milestones. Obviously, the success that you're having, John, you just alluded to customers with 3 or more modules spending over $500K. And I know historically you've said, I think your overall base monitors like 15 to 20% of their applications. But as you really move into full stack monitoring, full stack observability, is there a different way to think about penetration in these customers beyond just the number of apps monitored?
Yeah, Matt. So the way we look at it is that pretty much every customer starts in a segment. It's usually their most advanced cloud environment, where they want to bring Dynatrace in. They're the more dynamic, more complex environments where there's lots of blind spots, but there's also a lot of impact if they get it right. But that quickly expands to either other app stacks, cloud app stacks, or hybrid. And so, digital transformers, one of their characteristics is that they're moving from something to something. Otherwise, why are you transforming? So they usually have multiple generations. And so we start out, as we've talked about before, in the most advanced cloud environments, and then we come back and sort of sweep through the hybrid elements that supply those modern cloud applications. So that characterizes sort of the way things look to us. And it's hard to sort of peg, our customers are here, or is there a different sort of expansion? The fact is, digital transformation, as I said, is a journey. People are moving from everything they had before to something brand new on the other end of this. It will take them a long time, and the minute they're there, they're going to continue to evolve. So, I see this as, we're in early innings. It doesn't really matter sort of, exactly what things look like today. They'll continue to evolve and scale rapidly. I mean, just look at the cloud companies and how fast they're all growing at massive, multi-billion dollars worth of revenue. There's just a great opportunity ahead of us, we're certainly, lead at the enterprise space, and we expect to continue to do that. And, with that will come, growth across all the modules, as we expand our sort of footprint, our capabilities, and our reach into these customers.
Got it. Thank you. And then as we start to look forward to the federal year end, it was great to see you were awarded the AWS government competency along with your prior FedRAMP authorization. Can you remind us of what your exposure is to Fed spending, and how do you think about that into sort of your guidance in terms of like what sort of expectations you have on federal this year?
Yeah, no, I think we think the federal market is a fantastic opportunity for us, to continue expanding in. We're relatively early, in that. I think we talked about it about a year ago, in fact. The doubling down
that we were doing. We now have quite a good-sized team there. It's up considerably, well over 100%, year on year. The progress we're making is significant, but it's still off of small numbers. I think it's going to be more meaningful in fiscal 23 and 24, honestly, as far as a overall piece of the business. But we're really pleased with the progress that team has made, and we look forward to some great things from them, with partnerships that we're building, with some of the extensions and some of the new modules we're bringing out, like the AppSec module. These are things that fit Fed government extremely well at this moment in time, and so we're looking for great things from them. It's an important thrust.
No, it certainly seems like the government needs to digitally transform just as much as the commercial side. So well done, guys.
Thank you.
Thank you. Next question today is coming from Koji Ikeda from Bank of America. Your line is now live.
Hey, John. Hey, Kevin. Really nice quarter. Congratulations. Thanks for taking my questions. I actually wanted to dig into the prior question on that, the AWS Government Competency Award. Congratulations on that. Great testament to the platform's capability. I guess I was just wondering, could you talk a little bit about what the process is like for achieving, that award? How long does it take? I mean, what goes on with that process of getting awarded that competency award?
Yeah, that's a competency that is not really about some technical review. It's actually more about success with joint customers that you earn in the field. So that's a little bit more what that one's about. We have a great relationship with the AWS Federal, community. It's not just AWS themselves; it's the partners and that whole community there. And we have that with the other hyperscalers as well. But we were pleased to get that. It's a great calling card, but it's winning business. It doesn't just come in the door. You still have to go earn it. And as I just finished, we're leaning into it hard because we see it as a massive opportunity for us. I mean, I think everybody knows the U.S. federal government is probably like the sixth country, in the world as far as spend, IT spend, and they are digitally transforming slowly, but hopefully we can help them speed it up.
Got it. Thank you. And just one follow-up from me. Looking at the results, it really demonstrates the power of the Dynatrace platform and the strong positioning within the overall opportunity. I guess just looking out into the future, what is getting you most excited? Maybe from a product standpoint or an opportunity standpoint that we should be thinking about. And thank you for taking my questions.
Sure. Well, I think the thing that it excites us, there's two dimensions to it. Overall, I mean, of course, the cloud spend continues to go skyrocket. So that's sort of the underpinning, but that can float many boats. I think from our perspective, two things. The first one is that apps continue to be the high ground. You don't put a cloud platform in unless you're going to put applications on it, and you're not going to be able to digitally transform unless you're driving continuous innovation on top of those platforms. So the apps are where the strategic action is, and we're super good at it, and extending then to the full stack, cloud stack is, just gravy for us. The other piece is that these clouds are extremely complicated, and everyone needs to de-risk their cloud programs. And as they do that, they're going to look to automation and AI to help drive consistency, allow their best resources to extend themselves further. And that's perfect for us. I mean, that's part of our reinvention. We were the first to realize that the scale and complexity was going to outstrip human ability to keep up. And we built analytics at the core, some very sophisticated analytics at the core of our platform to handle, that data explosion that's going on, that complexity explosion. So that's the other one, is that's finally starting to resonate, up at the buying community, not just at the technical practitioners. And that's super exciting because it's a big differentiator for us and one that, is certainly helping us, consistently win against all competition, no matter who's there ahead of us.
Great. Thanks, guys. Thanks for taking my questions. Really, really great quarter. Congratulations again. Thank you.
Thank you.
Thank you. Next question today is coming from Jonathan Ruykhaver from Baird. Your line is now live.
Yes. Hello. Good morning. I'm wondering if you could talk about pricing. You guys have really been able to command a premium for your products, but just curious on your thoughts on how comfortable you are with that pricing strategy, just in light of the increasing number of resource or consumption-based pricing models we see from various competitors.
Yeah, well, I think there's a little bit of, sort of too much noise about pricing in the market, honestly. We really haven't seen that much change. Some people try to use pricing as a sort of deflection, for lack of momentum in their business. But we haven't really seen much, sort of impact their shifts in pricing, it's certainly not at the enterprise or the digital transformer level of the marketplace. We're aggressive where we need to be aggressive. We're consistent and predictable for enterprise customers. The thing that they hate most is our overages or things that they can't anticipate, and all of a sudden they get a bill for it. We live in this space. We know how these folks think. We structure, our pricing and packaging appropriately for them. And, we don't see sort of any reason to move too far off of the, what's working for us at this point, nor do we see, a moment in time ahead of us where we're sort of worried that all of a sudden something dramatic has changed. So I like where we are. I think we're smart and anticipate where the market is, and we listen to our customers and, make sure that we're predictable and transparent with them.
That's helpful, John. Thank you. Just a second question I have is just, the business analytics product. I know it's relatively new, but curious if you're seeing the emergence of a consistent use case that can drive, a more repeatable sales motion, or is it more one-off applications that you're seeing with that product?
No, it's one of the modules that drive, some of the 3+ module, expansion that we talk about. When you think about it, nobody really, wants to put, cloud infrastructure in. They don't really want to, monitor logs. What they're trying to do is they're trying to expand their business. They're trying to be more agile and more innovative, find new revenue streams, transform the business itself. And so they put all this in, in order to accomplish something, but you still need to measure, are you getting the customer experience you're expecting? Are you getting the business outcomes you're expecting? And that's where the business analytics piece and the digital experience pieces come in. They measure exactly what the value is on the output, the business value, so you can understand whether your investments you're making in the cloud platform and the applications are paying off. And if they're not paying off, why not? And what do you have to do to get that kind of return on investment for your IT digital transformation spend? So it's a really important, module for us. It'll continue to be. And I do think, more and more of the digital transformers are waking up to the fact that it's not just about the infrastructure they're putting in, it's measuring the value at the other end.
Very helpful. Thanks, John.
Thank you. Next question today is coming from Raimo Lenschow from Barclays. Your line is now live.
Hey, thank you. John, a quick question on the security on AppSec. You talked about the early progress there. How do you see that playing out in terms of the behavior you see from some of the security guys? Because it looks like they are realizing as well that, getting data out of security will be more and more important. I mean, you would seem like more the natural hub, but how do you see that evolving over time? And then I had one follow-up for Kevin.
Yeah, well, the reason that we entered,
where we did is we see it as a greenfield space. It's very hard to do continuous scanning in production without overhead. We have a fantastic instrumentation technology out in the and we see everything, code level detail. We see every entry and every exit point. So we have a visibility that is really unprecedented. And the second thing we do is we have the intelligence built in, an AI engine that allows you to actually score, determine what's really a vulnerability and what's not, and then score those vulnerabilities so you can always keep things prioritized for sort of the limited time your dev team has to spend on the security side of things. So that combination is very unique, and while others are trying to figure out just how to scan in production, we're already there, and we already and we have the AI engine to help make it to simplify that world. So it's a great place to come in. We have plans behind it, of course, but we believe if we stay in that application, that cloud application zone, first of all, it's going to be a rapidly expanding space. It's being disrupted tremendously, and we have a very unique sort of angle in from the observability, the intelligent observability we do. So we're focused more on what we're doing and how to maximize the value of it with the customers we have, rather than worrying too much about what competitors are doing at the moment. And I think that strategy has served us well in the past, and we'll continue to pursue it. And so far so good. And what we hear back from the hundreds of trials we've been doing is, this is spot on. We need it. How fast can you mature it so we can roll it out in volume?
Perfect.
Exciting place to be.
Yeah, sounds really exciting. And one for you, Kevin, as we talk more about like RPO going forward, I know you said ARR is the most important for you, but RPO will come up more and more. Are there any kind of drivers or trends that we should see? Just if you think short-term versus long-term RPO, so your long-term RPO growing faster than short-term, is there like some duration benefits you see from bigger engagement, longer engagement with customers, etc.? Thank you.
Hi, Raimo. So as we've moved to a fully subscription business, we have seen a slight uptick in our average contract duration, and right now it's approaching about 2 years. So that's sort of generally where we are from that standpoint. But the reason we focus investors back on ARR is we've gone out to our customers and we're signing multi-year agreements, but as they rip and replace existing contracts, it sort of resets the RPO numbers and deferred revenue and the billings numbers as well. So over the next couple of years, as we scale our customer base, as we get them onto 3-year agreements, and as they grow, it's just going to continue to create some variability in those different metrics, which is why if you really want to cut through all the noise around everything, we think ARR is the best metric. It's the leading indicator to subscription revenue growth, and the one we certainly focus on internally in our company.
Okay, makes sense. Congrats.
Thank you. Next question is coming from Tyler Radke from Citigroup. Your line is now live.
Yeah, hi. Good morning, everybody. So wanted to ask you first just on the new logos that you're seeing in the market. Obviously, a nice bounce back from Q1 a year ago. What are you just seeing in terms of their appetite to take on kind of the full Dynatrace platform? Do you find that you're landing with a broader set of solutions given the investments that you're doing? Just give us a flavor for how those conversations have progressed.
Yeah, no, I appreciate that. So, it's about a third of the customers, land with with a platform approach, a 3+ module kind of approach, and that's up, year on year. It's so that's maybe one item to take away. That's because the rise of this observability as a concept, sort of a landing zone. 2 years ago we talked about the application landing zone. Now we talk about an observability landing zone, which is a little wider, and we see that continuing. be surprised if that isn't, scaling up consistently quarter on quarter now for the next, 12 to 24 months. So that's an important characteristic. And I think that, customers, are, as they start to move, we're starting to see more do-it-yourself, kind of customers that are tired of trying to cobble things together. It's sort of a game that you just can never get on top of. You feel like you're always behind, and customers feel that way. And when they find out that, we already do all this and it's all automatic, and AI to help them, really transform the way they work, they're totally willing and happy to give up, the do-it-yourself approach. That's the other characteristic I'd say that's important. It means that people have already figured out the cloud's complex. They've already figured out that old tools don't work. That's why they're in this cobbling it together zone. And the more we find customers there, again, I think that multi-module footprint, will continue to expand at the landing zone. So those are a couple characteristics of those new logos that we're starting to see, and what the dynamics are in those environments. And I think just with the visibility we see ahead of us, we think that the momentum we've saw this quarter, maybe it's not a 50%, quarter over quarter, year over year, uptick, but we do see a good, steady, strong, new logo flow throughout this year. Probably a little bit ahead of our 15 to 20% guidance, long-term guidance we've been giving.
Great. And just one follow-up. As you think about your, kind of mix of expansion in new deals in APM that are tied to, obviously, application modernization, like how is that mix between, public cloud, kind of public cloud native applications versus, maybe hybrid cloud or private cloud? Just kind of, obviously, you talked about some, really nice momentum with the hyperscalers, but just kind of curious how that mix of where these applications deployed has changed, kind of between the hybrid private versus public cloud.
Sure. Well, so there's definitely a trend toward, more and more public cloud just in general. And people put hybrid clouds in not because they're going to lock down on hybrid, it's that they're transitioning or transforming, their environment over time. Every hybrid cloud that we run into has public cloud extensions. It wasn't that way 5 years ago, but it is today. Over 80% of our customers, are observing cloud native applications and containerized environments. So it's extremely modern set, of tech stacks, but they also reach back into data sources of record that are required just to run their business. An insurance company, it's a risk management system that's probably running on a mainframe somewhere or some other kind of, mid-range systems behind their firewall. They have to reach back to it. Banks, their customer, their customer data, transaction data, et cetera. Airlines. You go down the list of the digital transformers, you realize that, there are data sources of record that need to be tapped in order to support, the modern cloud front ends and, mobile applications we all use. So, with the way we think about it is that over 80% of the customers are in modern cloud environments. And it's, from our perspective, digital transformers will be, hybrid, highly hybrid, for, some years to come. We're extremely well positioned for that world and helping them move from the old to the new.
Thank you.
Thank you. Our final question today is coming from Eric Sebeter from JMP Securities. Your line is now live.
Yeah, thanks for taking the question, and congrats. On the AppSec module, now that you've been selling that for a little bit, can you talk a little bit about the competitive environment? Are you seeing the likes of kind of the broad solution providers like a Palo Alto, or is it more startups? And then secondly, you talked a little bit about sales and marketing up from the year ago quarter in light of some return to the office. Can you talk a little bit about where you are in terms of your sales organization returning to a more normalized spending level?
Sure. I'll try to handle these relatively quickly because I know we're sort of at time here. From an AppSec, standpoint, as I said, we're still in sort of the maturing and sort of early stages, of sales development, but we do know what that competitive environment looks like, and no matter what people have, they have gaps in production. And every one of these customers, sort of knows what this landscape looks like. Talk about, lots of tools out there. There's plenty of them. But this is a greenfield angle that we're coming in on. There's nobody that's doing what we're doing. It is a hole, and as you guys know from security, if there's a hole somewhere and you're a public company or a government agency, you're going to need to fill it. And so that's what gives us a lot of excitement around this space. Our timing is good. The angle we're coming in on is good. It is greenfield. And yes, there's lots of tools out there that people want to talk about when it comes down to, does it work? The answer is there's a big gap in the market. On the sales front, so, the sales organization's chomping at the bit to get back, to face-to-face with customers. And there's plenty of customers that are looking forward to that as well and already, engaging. In fact, I think some of our, travel, is for sales in particular is up, a big jump from, where we were when we were all locked down a year ago. So they're excited about it. But what I'd leave you with is this. We don't have to be face-to-face with customers to be successful. We already checked that box a year ago, and we've learned how to win with over Zoom. And we can continue to do it. If anything, back to sort of a little more normalcy and face-to-face will be an accelerant for us, both in onboarding new talent, as well as, I believe, building relationships with customers that allow us to expand faster. So those are some of the characteristics, but, either way it goes, whether it's a protracted pandemic or whether we're back to normal sooner, it's all good from our perspective.
Very good. Thank you.
Great. Hey, well, thank you, everyone, for joining us. We're thrilled with the dynamics of the market, moving toward us, as I said, in my prepared remarks. We're excited about, our ability to, invest in growth, both commercial expansion and in innovation. And we believe that as long as we stay focused on our two key metrics, the expansion of new logos, and the expansion, of our ARR, per customer, that we can grow a fantastic business, for years to come. So thanks again, and look forward to catching up a quarter from now. Cheers.
Thank you. That does conclude today's teleconference and webcast. You may disconnect your line at this time and have a wonderful day. We thank you for your participation today.